Everyone thinks that high earners get locked out of Roth IRAs, but the IRS actually left you a back door. And despite its name, it's completely legal. Most people who try this strategy mess up one critical detail that can cost them thousands in double taxation. Today, I'm showing you exactly how to execute this properly, including the mistake that even professional tax preparers get wrong. In the next few minutes, I'm going to walk you through the exact process of contributing to and executing on a backdoor Roth IRA contribution. You'll learn the two-step process and the critical mistake that trips up a majority of individuals who try to do it themselves, and the specific tax forms that can make or break your strategy. If you're a high earner who's been told you can't access Roth benefits, this could be a game changer for your retirement planning. Before we jump into things, an important disclaimer here. Everything I'm sharing today is strictly educational and based on current tax law. This should not be interpreted as specific financial or tax advice for your individual situation. So what exactly is a backdoor Roth IRA? It's basically a two-step dance around income restrictions. And here's how it works. Step number one, you make a non-deductible contribution to a traditional IRA. That's $7,000 in 2025 if you're under 50, or $8,000 if you're over 50. Step number two, you convert that traditional IRA into a Roth IRA, ideally within a few days of making that contribution, so it doesn't have a lot of time to grow. That's it. 2 steps. The IRS knows about this strategy and has blessed it, but this is where I see even smart and successful people get burned. The execution and the details can make or break the strategy. The first piece is the pro-rata rule, and this is the mistake that costs people thousands. Let me show you exactly how this plays out with real numbers, because I've seen this scenario destroy what would have been a clean strategy. Let's say you have $94,000 in existing pre-tax IRAs from old 401k rollovers. In this circumstance, let's say you contribute $6,000 to an IRA planning to convert just that $6,000 to a Roth account. Here's what happens. The IRS doesn't let you cherry pick which money to convert. They look at all of your traditional SEP and simple IRAs as one big pool. This is not the same and calculated as if you have 401ks. That's entirely separate. So what they do with the IRAs is they apply the pro-rata rule, which basically means that 6% of your total account balance now is the only piece that would be tax-free. The other 94% of your $6,000 conversion, that's now taxable. This happens countless of times where a successful person tries doing this without clearing out the existing IRAs. They think that converting the $6,000 ends up being tax-free, but you end up being hit with a tax bill because of the rule that we just mentioned. You essentially end up paying taxes on the same money. This is the same, and the number one reason I see backdoor conversions go sideways. People think they're being clever, but they end up questioning everything when that tax bill arrives. So let's talk about how to execute this properly. Step number one. Clear the decks. You need to eliminate any existing traditional SEP or simple IRAs. You basically have 2 options. Convert all of them to Roth IRAs. Yes, you will have to pay taxes on that amount now, but it gets you a clean slate. Definitely double and triple check this if you have a sizable account balance and you're considering doing this. The second and more frequently used option is you roll over the IRAs into an existing and current 401k balance so that you clear all of your IRA balances. Step number 2, make your non-deductible traditional IRA contribution. This is your after-tax money from your bank account or otherwise already taxed on going into the account. Step number 3, convert the IRA relatively quickly. Typically recommend within a couple of days to minimize any sort of earnings on that amount that will end up being taxable if it sits there for a while. This last step is crucial. Form 8606 tracks what is a not deductible contribution on the conversions. You miss this, you end up paying taxes twice on the same money. Exactly what we're trying to avoid. You can always go back and amend your tax return to fix this. If you did a backdoor Roth IRA conversion in any of the last couple of years, grab those tax returns right now and check your Form 1040 line 4B. This shows how much of your conversion was included in your taxable income. So for a proper backdoor Roth, this should only include any earnings, not your original contribution. You also should verify that your Form 8606 is attached to your return, showing your basis or contributions. And this is something I've seen tax preparers just miss entirely, or do-it-yourselfers miss oftentimes. Now, I had plenty of people who've come to me after reporting previous botched reporting, and they paid an extra anywhere between $1,800 or more in taxes that they didn't owe. What we ended up doing, and we can always do this, go back up to 3 years of tax returns and amend or just submit a corrected tax return so that you end up getting your refund back on the amount that was misreported. Now, based on my experience working with high net worth families and high earning professionals, the Backdoor Roth IRA makes the most sense if you're one of the following to consider. Above the income limits for the direct contributions, expecting higher tax rates in retirement, have levels of discretionary income that's available so that you can put it away for your future tax-free benefit, young enough to benefit from decades of tax-free growth, or thinking about estate planning and legacies. So Roth IRAs pass tax-free to heirs, which is a huge benefit for wealth transfers. If you're checking these boxes, this strategy could be a game changer for your long-term wealth building. While it doesn't really feel like $7,000 here and there every single year, it doesn't save a lot of money. If you're a married couple, or even you just do this consistently over the long term, that ends up saving a sizable amount of taxes if you zoom out from a 30,000 foot view perspective. The Backdoor Roth IRA represents something I see throughout the tax code: opportunities for those who understand the system and execute on it properly. This isn't about avoiding taxes, it's about not paying tax on the same money twice and minimizing our lifetime tax bill as much as we possibly can. Here's what I want you to remember. The details matter enormously here. One misstep with your pro-rata rule or tax reporting can turn a smart strategy into an expensive lesson. But when it's executed correctly, this strategy can help high earners access the same tax-free growth benefits that everyone else has access to directly. If this strategy makes sense for your situation, here's what I recommend. Number 1, audit your existing IRAs. Figure out what pre-tax money you have sitting around. Number 2, talk to your 401k plan administrator about rollover options of whether or not you can suck money into the 401k so you have no extra IRA balance. Work with a tax professional who specifically understands the backdoor Roth strategies and communicate it with them before you end up having a tax surprise, and document everything. This isn't a set it and forget it strategy and should be revisited every year. If you found this breakdown valuable, make sure to subscribe for more insights into strategies I use with my high net worth clients. I'm committed to democratizing the same level of financial knowledge that typically costs thousands in advisory fees. Thanks for watching, and remember, being a high earner shouldn't mean being locked out of smart tax strategies. Sometimes you just need to know where the side door is.